So anyone that knows me knows that I love index funds. I think they are the best investing option for 99% of investors due to their low expense fees and diversification. I really do think that index funds are just the best, but don't just take it from me. One of the biggest fans of index funds is arguably the greatest investor of all time, the Oracle of Omaha, Warren Buffett. Now, Warren Buffett has made a career of picking single stocks and achieving massive returns. But he is very outspoken about his stance that most people will not succeed doing that and would be better off just putting their money in index funds like the S&P 500. And to back this up, back in 2008, Warren Buffett challenged the entire hedge fund industry to a $1 million bet. And the terms of the bet were simple. If a hedge fund could outperform the S&P 500, which is made up of 500 of the largest US companies, over a 10-year span, the hedge fund would get the money. And out of all the hedge funds challenged, only one accepted. And they lost. Fun fact, Buffett donated his winnings to charity. So what does that tell us? Well, if top hedge fund managers can't beat out index funds, what makes me think I can? So this video will break down my 5 favorite index funds that I'm invested in 2023, and we'll go over stuff like average returns, expenses and fees, and other benefits. But first, I have to include the disclaimer that obviously none of this is official financial advice. These are just my personal favorite index funds that I invest in, and I am not a financial advisor and do not make financial recommendations. Before investing in anything, make sure to do your own research and, if possible, talk to a financial advisor. And another thing to call out is that these are the ETF versions of index funds. ETFs are simply a vehicle of investing that allow you to trade index funds like stocks, which means that you can also invest in these index funds across multiple brokerages. And there's a few key differences between ETFs and index funds, but just know that ETFs contain the same investments as their index fund counterparts and mostly operate the same, but in my opinion, they're more accessible and easier to trade. And lastly, before we get into it, make sure you hit that like button, and if you're enjoying this type of content, make sure you hit the subscribe button as well. And the first index fund that we were looking at is VOO, which is the Vanguard S&P 500 ETF. And this fund tracks the performance of the S&P 500, which, as I mentioned earlier in this video, is 500 of the biggest companies in the United States. The index fund equivalent is VFIAX, and its top 5 holdings are Apple, Microsoft, Amazon, Nvidia, and Google. And there are 505 companies in total included in this ETF. It has a super low expense ratio of 0.03%, an annual average return over 5 years of 11.39%, and over 10 years, 12.16%. And this ETF is a great option for investing in some of the top companies in the United States. And this has typically been a favorite among investors as they believe in the US economy and because of the great returns this fund has had over the last few decades. And another great feature of this fund is the expense ratio. At only 0.03%, the fees are basically nothing, which means more profits for you. All right, and next up, we're switching over to VTI, which is the Vanguard Total US Stock Market ETF. Now, this one may sound similar to VOO, and in some ways it is, but instead of just the top 500 companies, this one is tracking all public companies in the United States. The index fund equivalent is VTSAX, and its top 5 holdings are the exact same as VOO. But the total number of companies in this fund is 3,871. So this fund's going to include a lot of the smaller companies in the US and give you a much wider range of companies that you're investing in. The expense ratio on this is also 0.03%. The annual return over 5 years is 10.49%, and for 10 years, it's 11.62%. And like I said, this fund is for investors that want to capture the entire US market. The S&P 500 is only for the big dogs, meaning the big companies. So by using a fund like this, it'll allow you to invest in the smaller players as well. Okay, this next one is for our tech investors, which has been a booming sector of our economy over the last few decades. And it is VGT, which is the Vanguard Information Technology ETF. And VGT captures the performance of the largest information technology companies in the United States. Its index fund equivalent is VITAX, and its top 5 holdings are Apple, Microsoft, Nvidia, Visa, and MasterCard. The total number of companies is 364. The expense ratio on this one is 0.10%, which is still super low. The average annual return over 5 years is 18.77%, and over 10 years, it's 19.36%. And I like this fund because I genuinely believe that we are in a time of exponential technological advancement, and I believe that will continue. But at the same time, I acknowledge I'm not a tech expert, so this fund allows me to diversify among a bunch of tech companies. So as the overall industry grows, my investment will grow with it. Okay, now the next best investment in this video is to hit that like button and hit that subscribe button if you haven't already. All right, now back to the video. Now every fund we've looked at up to this point has been specific to the US stock market. So let's look at one that goes outside of the country, and that is VXUS, which is the Vanguard Total International Stock ETF. And it's pretty simple. It tracks the performance of all international stocks. And it's important to note that the US is excluded from this, so it's just international, nothing in the US. The index fund equivalent is VTIAX, and its top 5 holdings are Taiwan Semiconductor Manufacturing, Nestle, Tencent Holdings, ASML Holding, and Novo Nordisk. And the number of companies in this fund are a whopping 7,960. The expense ratio on this one is 0.07%, and the average annual return over 5 years is 2.77%, while over 10 years, it's 4.27%. Now you may be asking me, why do I invest in this fund if the average returns are so low, especially compared to the funds we just looked at? And it can always be summed up in one word: diversification. I'm still mostly invested in the US stock market, and it's actually not even really close. And I like to hold some international stock just to hedge my risk against my US investments. And you never know when things might switch and the rest of the world starts to perform just as well as the US markets. So I invest a little bit just in case. And that brings us to our last fund we're going to talk about today, which is VNQ, which is the Vanguard Real Estate ETF. And this fund tracks the performance of US-based REITs. Now, a REIT is a real estate investment trust. And it's simple. REITs are companies that own and operate income-producing real estate. And this allows people to get into real estate investing even if they can't afford to buy their own property yet. The index fund equivalent is VGSLX, and its top 5 holdings are a Vanguard index fund, Prologis, American Tower, Equinix, and Crown Castle International. And the number of companies in this fund is 165. The expense ratio on this is 0.12%, which is still very low. And the average annual return over 5 years is 5.68%, and over 10 years, it's 5.12%. And admittedly, this is a fund I just started investing in, so it doesn't make up a large portion of my portfolio, but I've wanted to add some real estate to my investing portfolio to balance out my stock positions. So while I'm saving up to get into real estate investing myself, this has been a great introductory way for me to get in the game. And that's gonna do it for this video, guys. If you found this information helpful and you wanna learn about more personal finance content and tips and tricks just like this, again, I would greatly appreciate if you could hit that like button and subscribe to the channel. And I'll see you guys next time. Thanks.